VA IRRRL Explained. We'll start by going over why veterans overpay higher interest rates on their mortgage than they need to, and how you can save a ton of money that you pay towards interest with this program. We're going to review
the number one way to increase your VA loan savings.
So what is the program? It's called a VA IRRRL, also called a VA Streamlined Refinance. But in the mortgage industry, we just say IRRRL, which stands for Interest Rate Reduction Refinance Loan, pronounced IRRRL. Yeah, like that guy. I don't know if it was a loan officer, a mortgage broker, or a veteran who first started calling it an IRRRL, but I can tell you this. When interest rates drop, IRRRL starts to become a veteran's best friend, and your interest rate's worst enemy. But there's one key reason most people aren't eligible, and it's that you must already have a VA loan. It's designed to save veterans money by lowering their interest rates and reducing their monthly payments. On top of the monthly interest savings the VA requires on this program, there's one other thing that can save you a ton of money on a new mortgage. According to an article in Forbes magazine, homeowners can save an estimated $10,000 on their mortgage by doing this one simple thing, which I'm going to explain in just a moment. But first, there's a quote I love from probably the most brilliant mind of all time, who once said, "Compound interest is the most powerful force in the world." He also referred to compound interest as the eighth wonder of the world. And we'll look at how lowering your rate and payment through this program gives you the potential to not only save money monthly by lowering your payment, but it also frees up cash flow, allowing you the option to take the monthly savings and pay down high interest credit card debt. It even reduces the amount of interest that you pay annually, which lowers your monthly payment or allows you to pay off the home faster simply by making the same payment you're already making and not paying a penny more. And if you pay down your home faster, it can potentially save you a ton of money over the life of the loan. I've even seen the potential savings in the hundreds of thousands of dollars many times in my career, which dates back to 2004. My name is Grillion. I'm the owner and head broker of Paradise Home Mortgage, where we specialize in VA loans. I've been originating VA loans for over 20 years. I've trained and educated hundreds of loan officers, veterans, and realtors about the benefits of VA loans over the last 2 decades. And I was the number one loan officer for VA refinances in my state back in 2016 and was named the local Things to Know mortgage expert on the Channel 2 News back in 2018. So number one, to safeguard veterans, the VA requires that the program must accomplish a net tangible benefit for the veteran. And number two, the veteran must recoup the cost associated with the transaction within a specific period of time. On a $600,000 loan, it needs to save you an estimated $3,000 a year in interest, which is obviously a good amount of money. And over the life of a loan, that really adds up. So the amount the VA considers significant and what they call the net tangible benefit is the amount the rate has to drop by is 0.5% to be eligible. And I know that 0.5% might not sound like a lot, but if your rate is 5% and you drop it by 0.5%, that actually reduces the dollar amount of interest that you throw away every month by 10%. So it can be a ton of money, a ton of interest reduced when we're talking it off of hundreds of thousands of dollar balances. So some rough math here, and a quick disclaimer. I'm not quoting any interest rates. These numbers are for illustration purposes only. So for the easiest math, if you're paying a 10% interest rate on a $600,000 loan, what does that mean? Well, it means you're paying roughly $60,000 a year in interest. Because that's 10% of $600,000 is $60,000. So if you drop the rate 1%, you save roughly $6,000 a year in interest. So if you drop the rate 0.5%, you save roughly $3,000 a year. Now, these are just rough estimates because the loan amortizes, so there's a detailed equation we can do to get the precise amount. But the best thing about this program is that if you're eligible, once you do it, it'll reduce the interest on your mortgage every month and every year going forward on autopilot, as long as you always go with a fixed interest rate, which is what I always recommend. So how much does it have to save you? Well, the rate has to drop by 0.5% or more. The great thing is, if you're eligible, it's not a one-time savings. You save money on interest every day that you're in the loan. But it's important you understand your break-even point, which we're going to go over. But first, have you ever looked at that box on your mortgage statement, your bill, the box that breaks down your monthly payment and shows you how much is going towards principal and how much is going towards interest each month? If you're like me, it probably makes you a little nauseous because sometimes double or sometimes even triple is likely going towards interest every month versus what's going towards principal. And it's the amount that you pay towards principal that actually pays down the balance. The part that goes towards interest just puts money into the bank or lender's pocket every month and does not help you in any way. So overpaying unnecessary interest is kind of like throwing money out the window while you're driving down the highway or burning money. Nobody wants to do it. Nobody loves a bank or a mortgage lender that much. I hope so, at least. So the great thing about this program is that it's designed to lower the amount that goes towards interest every month and actually every single day. Since you pay daily interest on a mortgage, you're saving every day. And it also allows you to pay more towards principal each month without having to pay a penny more than you're currently paying. This brings us to our next session. Why do veterans overpay on their mortgage? Well, many veterans today are paying interest rates that were locked in between mid-2022 and 2026, when rates were higher than they've been in years, because the Fed kept raising rates to fight off high inflation after COVID. Raising rates is the Fed's main weapon in their arsenal to fighting inflation and bringing inflation down. So if you hear that inflation is back on the rise, that signals that rates will likely follow and rates will spike like they did after COVID. But when inflation is under control, rates move down, a lot of homeowners don't realize that they may have an opportunity to improve their financial situation. Paying a higher interest rate than necessary can cost thousands of dollars per year in extra interest. That's exactly why the VA created the interest rate reduction refinance loan.
In addition to the IRRRL saving money annually, monthly, and even daily in interest, what can be even more impressive is the potential lifetime interest savings in dropping your interest rate on a mortgage, and how much faster you can pay the loan off by simply making the same payment that you currently make. For example, on a $600,000 loan at a 6% rate for 30 years, your payment is $3,597 per month. Now let's say you've been paying on your loan for 2 years, and after you've made 24 payments, your remaining balance would be just under $585,000. And if you do an IRRRL and drop the rate to 5.5%, if you were to raise the loan amount to $595 to finance in the cost and the payment that you get to defer, your new payment would go down to $33.78. So the monthly savings would be $218.96 per month. But the astonishing part is the total interest savings if you were to keep making that same $3,597, but at that 5.5% rate. You would pay the loan off in 311 months, just under 26 years, instead of the 28 years or 336 payments that you had remaining at the 6%. So you pay off the home 2 years faster at the same payment that you're currently making without having to pay a penny more and without having to make any big lump sum payments. And the total interest savings goes up drastically because more money would go towards principal and less would go towards interest each month. Because the total remaining payments you would pay at 6% would be $1,208,000. But at the 5.5%, you would only have 311 payments. And 311 times 3,597 equals $1,118,760, because you would pay off the loan in under 26 years at 5.5% versus the 28 years you had remaining at 6%. And that equates to an interest savings of $89,931. And you pay off your house 2 years and 1 month faster, eliminating over 2 years of mortgage payments.
Why the program is so powerful? Well, one of the reasons the VA IRRRL is so popular is because it was designed to be extremely simple compared to most refinance programs. Another name the VA even calls it is the VA Streamline. In most cases, there is no appraisal required and there's no termite inspection either. On other conventional refinance loans, you might pay upfront costs like application fees, lock-in fees, appraisal fees, just to start the process. But since these are not required on a VA IRRRL, you should not be charged anything upfront to begin. The VA actually specifically prohibits the charge of such fees before you start the process. There's also no income verification required, so no pay stubs, W-2s, or tax returns need to be sent in, because the VA knows if you're already proved that you can make the payment you're currently paying at the higher interest rate, then you should also be able to make the lower payment at the lower rate. Another benefit is that credit requirements are often more flexible. Lower credit scores are often not a problem, and in many cases, a hard credit pull is not even required, especially when using a mortgage broker. Because you already have a VA loan, the VA allows this process to be extremely streamlined. This is why many veterans say the VA IRRRL is one of the simplest refinance programs in America. But typically, the most important thing that customers are ultimately looking for is the lowest rate at the lowest cost with the lowest monthly payment, and that's what wholesale brokers work to provide. But I actually started out in 2004 working at major banks and big lenders early in my career. But even still, the first 3 homes that I bought for myself before I ever became a broker, I actually went through a mortgage broker each time, because the brokers had lower rates at lower all-inclusive costs than I can get myself, even with the employee pricing at the bank or big lender that I worked for at the time. So when combining the best deal with the best service, it was like getting the best of both worlds. Better pricing, faster closings, and less paperwork. But this isn't just me saying this. It's based on actual HMDA government data. According to an article in Forbes magazine, you can save over $10,000 on your mortgage by working with a mortgage broker. And more specifically, in another more recent Polygon research study, veterans actually saved over $13,000 on their mortgage when using a mortgage broker versus a bank or a direct lender. At Paradise Home Mortgage, our mission is clear: to help veterans obtain low wholesale VA interest rates while delivering the best of the best award-winning service all of our veterans deserve. My team and I at Paradise Home Mortgage have originated thousands of VA loans, so we know a little bit about them, and we want to show you how working with Paradise Home Mortgage can be the best decision you can make on your VA loan. Thank you for your service, and God bless America and our troops.